All right, good evening, everybody. Good evening. Good evening. Please, if you can hear me, I'd like to just type one in the comment section if you can hear me. Just type one in the comment section if you can hear me. I'm excited to be here again tonight. If you can hear me, please type one in the comment section. All right, just a moment, please. Hey. All right. Okay, thank you. Good evening. You're welcome. Now, let me quickly tell you something. My main interest, my main focus, or my reward for doing this, what I expect of you, what is my motivation. In 2019, 2020, I started teaching and training people how to trade financial market for free. And so, the more I train, the more I get excited about training people. And honestly speaking, 90% of all my trainings are free, 90% free. So the city where I was, every time I entered the supermarket, I see some of my boys that I've trained before, they're excited. Especially those that have become profitable at that time, they're excited, they greet me in the supermarket, they smile, they laugh, I'm excited. And my my initial motivation was trying to teach students who had difficulties in paying their school fees themselves. That was one of my first motivations for teaching people. I remember I told one of my students then that if you have students in your campus who are finding it difficult to learn to trade, just bring them to my office. So that was the first set of students I had. And ever since then, I'm always getting excited, somebody called me the other day. It was one of my students many years ago in Lagos. And I remember teaching him how to trade, crash and boom at one particular time. I remember a time after the guy mastered the strategy and I started making profit. His wife called. They were so excited one day in their house. He was with his wife and his kids, and the wife called me and just saying thank you, thank you. I was like, what exactly happened? He said the husband has made money and has installed solar in the house, so they no longer feel heat at night. They can on their fan 24 hours in a day, and then the kids are excited. They like to do the assignment every day. Why? Because the husband has made money and has installed solar in the house. So I'm always excited, and that is why I want to do everything possible to make sure that you get what I'm saying. Because if you don't get it, I won't get my excitement. I won't get. It is when you get it and you are profiting with it. That is when I can have testimony that look, oh, you are my student. I trained you, and you succeed in doing it. So I'm here to answer questions. I may not always be online. I may not always be available to answer questions, but I guarantee I will answer all your questions. It may not be immediate. may not be instantly, but you see, if you get it, is where my joy comes in. Please understand that. If I'm to bill you, I won't bill you a little token. In fact, one reason why I teach for free is that you can't pay me for it. You can't pay me. And when you start paying me now, the moment you pay me for it, you already buy a particular part of my school. My mind will always be there. So I love to teach people at my own time, my own schedule, not the one you force me into, because there is no way you can actually pay me, even if you pay me 3 million for my master class, or you pay me more than that. The length of time it will take you, how much I stand to gain, even if I'm studying, even if I'm sleeping, even if I'm trading, what I will gain, especially if it's one person, is much more than what your 3 million will cover, because I want to teach you. To take more than 6 weeks to teach you to become, like cover my entire syllabus. You don't get. So my goal is usually wherever I teach, let the person get it. Let it get. That's why I break the syllabus down, I'm teaching it gradually. So make sure you watch the videos, pay attention, especially if you have not been profitable before. Especially that's why this one is chicks in trade. My mindset is I'm training young, elegant, vibrant, fashionable, sophisticated ladies. My goodness. So please pay attention. Please pay attention. If you if I'm not profitable, I won't be bold. I won't be confident to share all of these things with you. And so it means that, in fact, my goal is that if all that I teach you is all that you know, will you be profitable? And since I'm profitable by my statistics, you will be profitable if you do all I do. Because see, I find out the reason I started saying that statement lately is the reason I started mentioning that statement lately is I discovered that you don't have to know plenty things to be profitable in the market. You just need to know few things very well. You hear me say it's not about knowing 1,000 things, it's about knowing one thing 1,000 times. It's about understanding one thing 1,000 times. It's about knowing very little thing that give you hedge in the market, and you know it very well. Now, if though there is no 1,000, there's no 100% strategy, but if your strategy is six, imagine you have a strategy of 60%. I have a strategy of over 90%. But imagine you have a strategy of 60%, and 6 out of 10 times you are winning. You have already made it. If you now have over 1 to 1 risk to reward ratio, you're already profitable. So the time you lose, just know that the market will give you the money back. I'm telling you. So please pay attention. Be humble enough to ask questions. In fact, the person who set me on the course to, who introduced, who reignite fire of forest in me many years back is even very much younger than myself. And I always humble myself before him, very much younger than myself. So please calm down, be humble, and then follow instructions. And then I guarantee you'll be profitable. It may not be immediately, it may not be in the next 1 week, it may not be in the next 1 month, but I guarantee you will follow everything we are sharing here, you're going to be profitable. All right, so let's continue. I'm going to be reiterating what we said yesterday. Rain is about falling here, so I have to rush before the sound of the rain keep you away from hearing me, okay? And so let me quickly share my screen with you. Let me share my screen with you. All right. Let me share my slide to begin with. Sharing with. So my slide here is saying, yesterday I was telling you different kinds of markets. I was telling different kinds of markets. And I was telling you there is a market patterns. There are 4 market patterns. I didn't talk about the fourth one because the fourth one, the number 4, is called the choppy market. Choppy is a market that has no direction. It's just choppy. Is consolidating. It's just choppy, no direction. Sometimes when you enter the market, maybe during the holiday time, the market is just choppy. Or you enter the market during maybe some time in Asian session or before pre-Asian session, that is bullish or bear uptrend market. We have higher highs and higher low is said to be in an uptrend. Okay, and when the market is making a series of lower highs and lower low trend, and when you have a fixed resistance or fixed support, we said the market is ranging. We also call it a sideways market. The market is moving to the right or to the left. It is called is moving to the right, the sideways market, it is said to be in an uptrend. Or sorry, it's said to be a ranging market. I'm trying to look for the diagram I showed you yesterday. Okay, it's said to be a ranging market when it has fixed support and fixed resistance. When market is moving between a fixed support and a fixed resistance, we call it the floor and the ceiling. It is said to be a ranging market. The market is said to be ranging. The market is said to be ranging. And therefore, when the market is in an uptrend, what do you look for? You look for the opportunity to buy. Never forget that statement. You look for the opportunity to buy. When the market is in an uptrend, higher highs and higher lows, it's forming higher highs and higher low, you'll be looking for the opportunity to buy. Don't try to sell in an uptrend market. It's a rule because trend is your friend. You must follow the trend. That's the only way a retail trader will make money in the market. And you and I are retail trader. You can now see why I told you that day, I'm a retail trader, therefore trend is my friend. You are not a market maker. You are a diver on the sea. You cannot generate the wave. You wait for the wave and ride on the wave. You are the mercy. You wait for the wave to be generated because you cannot create the wave. You're not a market maker. You don't produce liquidity in the market. The banks produce liquidity. The central bank produce liquidity. The commercial bank produce liquidity. The corporate organization produce liquidity. It is not you that produce liquidity. Now, but when okay, for example, but when you trade derivative synthetic indices, you are trading against a robot. Nobody's producing liquidity on derivative. You're trading against a programming, a code. You're trading against a code. You're trading against programming. You're trading against a bot, a robot. So you're trading against algorithm. You're trading against an algorithm. And so that one does not depend on human effort. It doesn't depend on how much a bank is putting. It's strictly trading against computer algorithm. And you discover that I'm a little bit I'm not being so loud in trading, in talking about the synthetic index, because we're going to go to that one later because of just a little difference there. But it's the same principle, just a little different. It's the same principle. So the market is making series of higher highs and higher low. Therefore, I'll be looking for the opportunity to buy. When the market is making series of lower highs and lower lows, therefore, I will be looking for the opportunity to sell. I'll be looking for the opportunity to sell. When the market is making series of lower highs and lower lows, I'll be looking for opportunity to sell. And then when we have a ranging market, when the market is between fixed resistance and fixed support, you discover that you just got to a particular market, you discover that it's not breaking the resistance. It's not breaking the resistance and it's not breaking the support. The market is moving sideways. So what do? The moment you see that history is about to repeat itself at the resistance, you'll be looking for opportunity to sell at the resistance. When you see history trying to repeat itself at the support, you look for opportunity to buy at support. So we have uptrend, we have downtrend, we have ranging market. And the fourth one is the choppy market. The choppy is very choppy, just consolidating, no direction. It's not moving anywhere. Exactly when you look at the smaller time frame, it's not moving anywhere. Just close your system and walk away. Just stay away from it. Walk away until you are seeing a defined pattern, a defined market structure formed. Okay, so we now go to where we were. We went to the chart yesterday. I said, now, so if the market is an uptrend, is trending, how do you trade a trending market? Because now you have basically two types of market to trade. You have trending market, whether uptrend or downtrend, and then we have ranging market. Period. There's nothing more to trade in the market. When the market is trending, how do you trade it? Then when the market is ranging, how do you trade it? I've told you how to trade it. How to trade the ranging market. You buy at support, you sell at resistance. The same thing happened on trending market, but it's a little bit different. Okay, it's a little bit different on a trending market than ranging market. So, but then before I actually go deeper into price action, maybe we're going to begin that one tomorrow. I just want to teach you a cheat, which I taught you yesterday. I want to re-emphasize it. This cheat, when the market is trending, okay, when the market is trending, I remember a couple of years back when I had some students who make tremendous, crazy money trading crash and boom. They made so much that they went to buy house and they bought land in Lagos. I don't know if I've told you this story. They were arrested until they retired trading in the lawyer's office, and they were making money in the office of the lawyer. That was the only thing that rescued them because they thought they were Yahoo boys. 20 level students, first semester, they were arrested. But as at that time, the market was trending. Crash and boom was trending in year 2020. Of course, it has trended after then too. But that particular time, crash and boom was trending, and they were taking a very crazy way, and they make stupendous money. My goodness. You know, when you make some money that they went to buy house, they make some money, they went to buy land. They didn't buy land in their own city, they went to buy land in Lagos, buy house in Lagos. They didn't buy car actual house. And how did they get the money? The total money was gotten trading from crash and boom. Now, very sweet to trade. Very, very sweet to trade. You will make money as if it's the magic. Most time when people lose money, it's because maybe probably the market is ranging, consolidating, or just ranging. The moment they say it's to buy, the market is already selling again. Say it's to sell, the market is already buying again, and then it's just ranging, up and down like that. So now, when the market is trending, it has a different strategy of trading it. A strategy for trading it, and I love trending market. When I started to trade, I used to like ranging market, but now I trade all of them. There's no kind of market that I cannot trade. I trade both trending market and ranging market perfectly well. But you see, when the market is trending, it's very sweet to trade. So I'm going to be teaching you all these things you are seeing on my board now. They are strategies to trading trending market, EMA, or you can also call it. You can also use SMA. EMA means exponential moving average. Oh boy, I'm so excited. And SMA means simple moving average. The moving average, the one I was setting yesterday, don't worry, we're going to do it again today. Then we have the ADX. ADX, average directional moving index. Average directional moving index. Now, these two things that are on my board now, I don't use them anymore. But that's how I started to trade. That's how I made my first $400. That's how I started to trade years back. Because you see, when I started to trade, I didn't know nothing about price action. And that's the problem that majority of you have. You don't know anything about price action. This is a strategy that probably cannot be sustained over the foundational principles. Okay? Because you see, for you to make money in the market, you have to think the way majority of professional traders will think. You have to think the way, you have to use strategy that is globally recognized. For example, trend line, globally recognized. Trend line breakout, globally recognized. Fibonacci, globally recognized. Support and resistance, globally recognized. So we're going to be going to this one after the other. And this can take us a couple of days. Honestly speaking, this will change your life forever. I'm telling you. And so now, today I'll be focusing on reiterating the combination of moving averages. That's EMA and SMA. But then I'll be focusing on exponential moving average and simple moving average. Exponential moving average is a little bit, I just fell in love with it when I, over simple moving average. Simple moving average is just simple. Because you see, average, from the word average, is the summation of variables, okay, over the number of those variables. So when we are looking at, okay, simple average 10, when you say period 10 will mean 10 days. All the price for the last 10 days divided by 10. Then we tell you the direction of the market. But when you say exponential moving average will also tell you the summation of all the 10 variables in the past 10 days, okay, then divided by 10 with stronger emphasis on the most recent dates. Stronger emphasis on the most recent date. Well, that may not necessarily be what I should go into those calculations actually, but then it's more prompt, it's faster, even though it has its own weakness by it responds to spike fast. It has its own weakness by it can be very fast. It can be very fast because especially when there is spike. But then simple moving average is more stable, and then it can also lag. It can be slower. Okay, so I'm going to be teaching you that so that in case it's good, because the reason I'm trying to teach it again now is because I've seen people all over the world who still use indicators to trade. I see people from all over the world. I see people that trade stocks, that trade bond, and all that they use to trade is moving averages. When this one cross this one, they buy. When the people still use stochastic, people still use RSI, people still use indicators. My goodness, I don't use an indicator anymore. But I want to begin from here because always in my class I teach it in case somebody is busy, in case somebody just want to like write on a trend. And when the market is trending, you have this, this thing will pay you like crazy. Now, in addition to that, is the fact that some instruments trend more than the other instruments. Some instruments trend more than the other instrument. For example, at average, every instrument trend for about 40% of the time on the average. Every instrument trend for about 40% of the time. And so if your strategy is going to be moving averages, then you've got to look for instruments. You've got to look for instruments that stay trending most of the time. So I was giving you examples yesterday of instruments that stay trending most of the time. If you're someone who is always busy, if you're someone who wants to stay on a trade for a long time, you want to ride on a wave on trend for a very long time, then you have to look for instruments that trend, for a long time. Instruments that trend for a long time. And I gave you an example yesterday. Number one, gold. Gold trends a lot. If gold is buying, is buying. If gold is selling, is selling. Okay? If gold is buying, is buying. If gold is selling, is selling. I'm telling you. So it's trend for a long time. I told you since August last year, gold has been trending. Gold can trend for a whole year. For a whole year or more, or for several months, it can trend. There's some instrument like that can also stay trending for a very long time. Number one, gold. Number one, let me write it here. Okay. Number one, gold. Gold trend so much. What am I writing? Gold trend, stay trending for a very long time. So we're going to use this strategy. You read your instrument and trend. Number two, especially USD30 made money in the past so much. USD30, USA 100, that's Nasdaq. USA 30. Then after that one, stock trend. You can have Tesla. I think Tesla trend, Tesla, and some of these instruments. Then after that one, you have I think GBP USD trend. Then GBP USD trend. Then I have USD JPY stay trending. They trend a lot. Then we have what else? Okay, I have US Nasdaq, gold, GBP USD, USD JPY. Then I think GBP JPY also stay trending a lot. GBP JPY. In other words, you can be on the trade and stay there for a very long time. Now, when it comes to derive, don't mind how I'm writing that. I don't want to change the screen so that the system will not lag. So you have derive there. If you have derive there, on derive now, you have volatility 100. You have V100. These are the instruments that trend so much. They may not trend 100% of the time, but they stay trending the most. V100. Then I have V75. Then I have V50, and I have V50, V51S. Then I have on the synthetic indices. Then I have, now listen to this last three I want to share with you. They are crazy. They are very crazy. Step index. With this step index, you need to have a little money before you can trade it though. Step index 300. My God, is crazy. This guy can trend. This guy can make you a millionaire within the shortest period of time. I'm telling you, step index 300. Then crash 500. Crash 500. This guy trends so much. Crash 500. Now, another guy that trend a lot, that I like, boom 900. My goodness. My goodness. After boom 900, I have boom 500. Boom 500. And that's all that in my archive now on instrument that state. If you use this strategy I want to share with you now on this instrument, but I am patient with them. You are patient, you can ride the waves. My goodness, you can ride the waves. Oh boy, you're going to make a lot and a lot of money. See, Forex is not gambling. See it as a business. See it as a side playing bets. Oh, yeah, like 5 minutes, you don't want to come out and no. Calm down. It's a business. It's a business. And I told you, if you don't know nothing and you're just making profit, it's an insult on those who have made it, who have made a career. I'm telling you, it's a very tough business, and nothing is as rewarding as it. Are we together now? Are we together now? If you are still with me, please type 2 in the comment section. If you are still with me, type 2 in the comment section. Type 2 in the comment section. If you are still with me. If you are with me, type 2 in the comment section. If you are with me, type 2 in the comment section. All right. All right. All right. All right. So let's proceed further. Let's proceed further. So let's use. So let's do this EMA and ADS combined together. Okay, let's combine these instruments together and let's see how they go. Okay. Okay. So let me share this other screen with you. Are you able to see my screen now? Can you see my screen now? If you can see my screen, please type 3. Don't start affecting the network. All right. Now you can see my my red line. Yeah. Let's continue. So I want to set the other. Then I click on insert moving average. This time around, my period is 50. Period 50. Method exponential. Apply to close. Style red. Sorry, no, style. The color here is blue. The color I'm looking for now is blue. And I click on blue. Then the blue line, as is showing now. The blue line is showing now. The blue line is showing now. And the third line, the third one, insert indicator, trend, moving average. This time around, I'm putting 200, exponential, apply to close. Then the color this time around is black. The color this time around is black. Then I say send. Then a black line will be there. This black line is there. Now this is good. That trends a lot because this strategy is for trending markets. That's why it's trending market is when the market is trending. And so what are the rules? What are the rules to use to trade this with this strategy? When the market, okay, I told you the rules yesterday. And what is the rule? I said when the red line, rule one, when the red line crosses the blue line from down up, buy. When the red line crosses the blue line from down up, buy it. Okay, that is rule one. Rule two. Rule two. When the red line crosses the blue line from up down, sell. When the red line crosses the blue line from up down, sell. Okay, then we have the third one. When the red and the blue line, when the red and the blue lines cross the black line from up down, okay, sorry, from down up, and you buy. Sorry, buy. That means a very strong buy. When the red and the blue lines cross the black line from down up, okay, from down up, this cannot take more than this. So I'm just trying to manage. Okay, from down up, buy. You cannot take more than that. Okay, from when the red and the blue line cross the black line from down up, buy, strong buy. Now the fourth one, of course, the fourth one is just When the red and the blue line cross the black line from down up buy. From down up buy. Then we have the final statement, which is we have the final statement. Which is when the red and the blue line cross the black line from up down, then you sell. When the red and the blue line cross the black line from up down, you sell. Sorry about this this way. I'm just trying to manage that because the more I switch window, the more the chart, the more the system will lag. So when the red line, the first rule is when the red line cross the blue line from down up buy. When rule 2, when the red line cross the blue line from up down, sell. When the red and the blue line cross the black line from up down, when the red and the blue line cross the black line from down up, buy, strong buy, buy, double buy. When the red and the blue line cross the black line from up down, sell. That's a very strong sell. So let's test that principle on gold. So let's go and begin from January, and we're going to be testing it on any time frame of your choice. Is okay. Any time frame of your choice. But the smaller the time frame, the more you have to sit with the computer. Then the higher the time frame, the lesser time you need to spend with the computer. So let's see from January 1, 2025. January 1, 2025. So let's see. On the, I want to test on 1 hour time frame. From January 2025. And so here, let's begin from here. When the red line crossed the blue line from down up buy. So the moment this crosses, you enter your buy, and then you will stay in the market until there's a reversal candle that crosses back the blue. The blue is usually our stop loss. So that means if you have entered the market from here, when the red line crosses the blue line from down up, you will have entered the market from here. And guess where you're going to be coming out of the market? You'll be coming out of the market from at this spot, at this juncture. You'll be coming out of the market here. You're coming out here. And how many pips is that? From the beginning? You have on gold 330 pips. But 332 pips. You'll have moved 332 pips from here to here. Now it has crossed it down from up down. If you had entered a sell from here, and then though you're probably likely going to lose this trade. But what I used to advise people is that the moment market move a little bit in your favor, come to break even and allow the market to run on its own. So if I enter this trade here, maybe you might have lost some money. So it crosses back again from down up. I'll be entering here. I'll be entering when the red line crosses the blue line from down up. I'll be entering my trade here, and then guess what's going to happen? I'll be on that trade until another candle close in the opposite direction and close below the blue line. I'll come out of the market from here. Now, price has entered, it has gone up again. Like, for example, you will just know that don't sell gold in that particular, just don't sell gold because the sell will not be much. So here again, the red line has crossed the blue line from down up. I'm going to be entering a buy. So when that thing is happening here, is this candle that is forming. When it is crossing, it's most likely this candle here that is forming. So I entered a buy. I enter a buy. If I enter a buy, I'll be on that market till it crosses back in this place. And guess how many pips is my profit? 352 pip profit. Now it has crossed back again. I'm going to be in profit. Sold it here. If you have sold here, for example, in this place now, your stop loss will be the last swing or above the candle that took you in, the candle that gave you a signal to enter. If this candle gave you a signal, definitely your stop loss will be here. And I guarantee you will have lost even if the did not go so much in your favor. Now it has crossed again in this place, and then it is still running. Okay, it crossed back. You will not just sell in this trade. In fact, I have another way I used to sieve this thing. When the candles are above the 200 moving average, I will only be buying. I will never sell when the candles are above the EMA moving average. But I just want to teach you the basic first. Then later you can now say, okay, I will only be looking for a buy when the candles are above the 200 moving average, and I will only be looking for a sell when the candles are below 200 moving average. And I think it will work well for gold. When the candles are above this 200, this 200 EMA, I will only be looking for a buy. 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 I will not sell it because the candles are still above. Then I will only be looking for a buy. I will only be looking for a buy. Now it has crossed it. Now when you say when the two lines, when the red line and the blue line cross the black line from up down, sell, sell. That was the fourth rule. Both of them have crossed. And when they were crossing, First of all, this one has crossed from up down. But if you assume that, okay, I'm not going to take that one. Now they have crossed to the downside of the 200 moving average. The 200 moving average. So what do you do? Now, see, it has crossed that. When it's crossing, maybe my entry, when they both cross, when this one crossed here, when this one crossed there, my entry is here. My entry is this candle that took me in. And then guess where I'm going to be coming out of the market? If I say I will not come out until a candle closes above, the 50 EMA, and guess what? I'll be out of the market here. I'll be out of the market somewhere around here. And guess how many P profits I have there? I'm going to be having that on how many P profits? That's 379 pips profit. 379 pips. Now they are up again. They are up again. They are up again. It has crossed. Both of them are crossed from down up. I'm going to be looking forward to a buy. And this place now, you are most likely going to be losing money. Why? You see, you have already seen a ranging market. Did you see a ranging market? You've already seen a ranging market at this spot now. You've seen a ranging market here. You've seen a ranging market. The market is moving from here, and then is also, is ranging between a fixed resistance and support. So this trade does not work well when the market is ranging. So the moment I see these two repetitions like this, what I do is, in those days when I used to use this kind of strategy, as a beginner trader, what I used to do is I just get a rectangular box. The moment I see two repetitions, I just get a rectangular box. I'll just box it. Even sometimes I still do this. When I see when the market is consolidating, I just box it until it comes out of this box. I'm not going to do anything to this signal. I'm not going to buy. I'm not going to sell until I see it coming out of when I see it coming out of this box that I formed. When I see it coming out, so you just draw your box. So I just draw my box like this. I draw my box like this, and until the price comes out of that box, I'm not going to enter. So now the price has this thing has crossed from down up. Both of them have crossed. And I told you when both of them cross the black line, it's always very massive. It's always very, very massive. When the red line and the blue line cross the black line from down up, buy. Ah, my goodness. Heavy buy, strong buy, double buy, massive buy. And both of them have crossed here now. They have crossed the EMA 200, which is the black one, from down up. Pum! So you just imagine when they are crossing, you are entering probably around here. You are entering probably around there. In fact, you have already entered somewhere around here. Somewhere around here. So this is your entry. And you're going to be staying in the game until a candle closes. Oh my goodness. Oh my goodness. Did you see? Did you see? This is 1,109 pips. 1,109 pips. Brother, that is massive. That is crazy. That is crazy. That is crazy. I don't understand how crazy this thing is. It will make you money. This is how to trade a training market. Okay, you don't have to come out of training market. There's no, you see, this kind of market you enter, you don't have to take profit. You only have a stop loss. So what happens when you enter from here? The last swing or the candle that took you in, the last swing, usually your stop loss is supposed to be somewhere around here. Your stop loss is supposed to be around, is either here or here. Okay, either here or here. That will be your stop loss. So now let's quickly do something. Let's quickly do something. How many pips am I risking? This guy is risking. Now, let's see now. Let's go calculate something. How many pips am I risking? I'm risking 280 pips. 280 pips. So the risk is 280 pips. 280 pips. Now let's watch it down. Now the target, if this trade comes out and wins in profit, is the profit is 1,119 pips. 1,119 pips profit. Profit 1,119 pips. 1,190 pips. So now, what is the risk to reward ratio in this place? The risk to reward ratio. What's the risk to reward ratio? All you do is just calculate, just calculate, just your calculator and divide your target, this is your profit, divided by the how much you are risking. Divided by how much you are risking. Okay. Just want to show you on the screen. Calculator. Let's see how it works. Let's see how it works. Calculator is booting. My calculator is booting. And now I've stayed there. Time is already gone again. Now. Calculator. Okay, let me use calculator on a device that is there. That is 1119 divided by 280. So you have 3.99. So your risk to reward ratio, is when the prices are above the sell, I will not take a sell. When the prices are above, I want to take a buy again. I will take a buy again. And then if I ride on that wings, okay, now if I enter it again, okay, from here, this will be my entry. This will be my entry. I can imagine that I'm going to be riding. I told you when it crosses back to the blue is where I will come out of the market. And so imagine from here. Now, when I enter here, where do you think my stop loss will be? My stop loss will be last swing, this place. This will be my stop loss. Now, in this case now, so if I enter here, I'm taking an entry from here to here. My target, my profit is 811 pips. It's 811 pips profit. 811 pips. And what is my stop loss? What is my stop loss? My stop loss is 152 pips. Imagine my risk. 152 pips. Can somebody now tell me this is gambling or this is a scam? Can somebody tell me that this is a scam now? Even this simple strategy I'm teaching you, you can sit down with this and make money for the rest of your life. Just this strategy I'm teaching you now. You just stay there, just watch. There are times you will lose, but when it's going to deliver result for you, you will win big. I'm telling you. So what's the risk to reward ratio here? 811 divided by 152. 811 divided by 152. That's 5.33. Can you imagine? Can you imagine that? Can you imagine risk to reward ratio? Okay. risk to reward ratio, RR. I'm telling you, 5.33. Can you imagine this kind of a thing? My goodness. Did you see trade? That means you are risking 152 pips to gain 811 pips. How can somebody tell me that this is gambling or this is a scam? This is not a scam. Oh. Now, so both of them have crossed from up down. By the time they are crossing, probably this candle is forming. Probably this is the candle that is forming. This is the candle that is forming. This candle has formed now when both of them cross. So I'm going to stay on that lane until it crosses back up like this. It's crossing back up like. So when it's crossing back up like this, my stop loss will be here. Sorry, my stop loss will be the last swing that took me in, and then here. So this time around now, this is one of those times when your risk to reward ratio is not much. Here now, I'm targeting 519 pips, but then I'm risking uh 698 pips, 698 pips. And so imagine both of them have crossed again. I told you when both of them cross, it's always very crazy. Both of them have crossed here again. Oh my goodness, my goodness, my goodness. Oh boy. Now, both of them have crossed again. My entry, when they are crossing, when both of them are crossing, probably this is the candle that is forming, that is forming now. Oh boy, oh boy, oh boy. Now, and we're still on this game. The thing is moving, the guy is moving, the guy is moving, the guy is moving, the guy is moving. Oh, pum! This is where I go come out of the market. Ash, boy, this is where I will come out of the market. See my entry here. See my entry. Now, if I enter from here, my stop loss will be the last swing, probably somewhere around here or somewhere around here, at worst around here. So here now, guess what my risk will be? My risk is going to be, my risk is going to be, boy, we have spent so much time here. My risk is going to be 787 pips. Risk. This is good. Though. That is much like that. Good. Risk. 787 pips. Pips. And then my target, how many pips am I targeting from here to this place? 3,127 pips. 3,127 pips. Oh my goodness. Profit. Profit. 3,127 pips. Can you imagine that? What kind of risk to reward ratio is this? Risk to reward ratio, R to R. My goodness. R to R. That's 3,127. 3,127. Okay. Divided by 787. And then you have risk to reward ratio of 3.97. R 3.97. Okay. 3.97 is the risk to reward ratio. Oh my goodness, you're not seeing my screen for where? Why are you not seeing my screen? You're not seeing my screen. You're not seeing my screen. Did you get how we arrived to this place? Oh, network is unstable. Ah. Did you get how we arrive at this place? Arrive at here. Where did we get to when you're no more seeing my screen? Because I was just going on. Where did we get to when you stopped seeing my screen? I need somebody to tell me where we got to stop seeing my screen. Okay, so this is what I'm going to do now. I'll record a video for you and drop it with you tonight. Is that okay? I'll record a video for you and drop it for you tonight. So I'll see you again in class tomorrow. But I think before the class tomorrow, I'll record this video and drop it for you. Maybe because of the rain here, the network was not clear. But I'd like to know where we got to when you stopped seeing my screen. When you started the calculations. Okay, yeah, no problem. Just be calm. Be calm. I'll give you a much more detailed video before class tomorrow. Just stay tuned. You will get it. You will get it. But somebody is asking, give me those line settings. Don't worry, I will do it again. I will let you know. We've already spent over 1 hour in this place. I don't want video to be too long, to be longer than this, so that because some people complain about data. So that you don't need so much data to be able to watch them. I'll see you again in class tomorrow, but hopefully before then I will have recorded another video.